Right now, Tilray is trading at $9.065, reflecting a modest intraday climb of 0.83% as of 11:23 a.m. on January 8, 2026. While that slight green tick might seem like a standard breather in the volatile world of cannabis, there is a much heavier narrative unfolding behind the scenes that most casual observers are missing entirely. Today is not just another Thursday for this company. It is the day Tilray reports its fiscal second quarter earnings for 2026, and the stakes have rarely been this high. If you are watching the ticker on your Robinhood app or checking your individual brokerage account today, you are seeing the result of a massive tug of war between the high-flying expectations of federal reclassification and the grounded, often harsh reality of a balance sheet that is still struggling to turn a consistent profit. The big insight here, the one that is currently causing a quiet frenzy among institutional desks at places like Fidelity and Interactive Brokers, is not just about the numbers on the page, but about how Tilray is fundamentally attempting to outrun its own identity. Most people still look at Tilray and see a marijuana company, but the reality is that they are pivoting so hard into the beverage space that they are practically a craft brewery with a pharmaceutical side hustle. This distinction is vital because while everyone else is waiting for the government to move, Tilray is trying to build a business that doesn't need the government to save it. However, that transition is costing them a fortune in capital, and the market is starting to lose patience with the wait-and-see approach. Expectations for the cannabis sector have been on a localized high lately, largely fueled by the executive order from the Trump administration in December aimed at accelerating the move of marijuana to a Schedule III substance. The common belief is that this reclassification is the magic wand that will solve everything, eliminating the brutal tax burdens of Section 280E and allowing Tilray to finally breathe. That's the expectation. The reality, which we are seeing reflected in the heavy technical resistance at the $11.30 level, is that reclassification is not legalization. It changes the tax code, but it doesn't open the floodgates for interstate commerce or fix the massive oversupply issues that have plagued the Canadian market for years. When you look at your online investing dashboard, whether you use the SoFi trading platform or prefer the advanced tools on the Interactive Brokers platform, you see the daily swings, but you don't always see the institutional activity. In the last few sessions, we've seen significant volume spikes that suggest the big players are positioning themselves ahead of tonight's report. There's a clear tension here. On one hand, Tilray has a massive cash reserve of roughly $265 million, which gives them a safety net that many of their smaller peers simply don't have. On the other hand, their margin pressures remain intense. They are spending heavily to launch Tilray Medical USA and to expand their dry January beverage lineup, which includes everything from zero-proof spirits to hemp-derived THC drinks. If you are looking for investment help to navigate this, you have to realize that Tilray is currently a binary play. The expectation is that they will eventually dominate the U.S. medical market through their physician-driven distribution model. The reality is that this model is expensive to build and requires a level of regulatory clarity that we still don't fully have. It's similar to the volatility we see in high-growth tech like NVIDIA stock or Tesla stock, where the future potential is so large that it often masks the current fundamental weaknesses. But unlike NVIDIA stock, which has the cash flow to back up its valuation, Tilray is still fighting to prove that its diverse house of brands can actually produce a net profit. Speaking of your portfolio, I want to hear from you. Comment below how many shares of Tilray you currently hold and whether you are buying this dip or waiting for the earnings call results to settle. It's always interesting to see how the sentiment on the ground compares to the institutional narrative. If you are using a robo-advisor like Schwab Intelligent Portfolios or managing a self-investing strategy, you are likely noticing that Tilray is currently testing its 200-day moving average near $8.76. This is a critical level. If the earnings report tonight shows even a slight miss on revenue, or if the guidance for the rest of 2026 is cautious, we could see a break below that support. Conversely, if CEO Irwin Simon can convince the market that their beverage segment is finally scaling towards profitability, that $11.30 resistance could be back in play very quickly. Looking at the broader market context, Tilray is increasingly being viewed through the lens of a consumer packaged goods company rather than a pure-play cultivator. This is a smart move for long-term survival. By acquiring brands like Montauk Brewing and 10 Barrel Brewing, they have established a distribution footprint that their competitors can only dream of. When you invest online, you are often looking for these kinds of strategic advantages. However, the cost of acquiring and integrating these brands has kept their earnings per share in the negative for quite some time. The expectation was that these acquisitions would be immediately accretive. The reality is that the Project 420 savings of $25 million are being eaten up by the costs of launching new product lines in a crowded market. For those of you managing your Fidelity IRAs or utilizing Fidelity Wealth Management services, you know that diversification is key. Tilray is trying to diversify itself, but it is doing so at a time when the cost of capital is still a concern and the regulatory landscape is shifting under their feet. They are essentially trying to build a new category of functional beverages that sits between alcohol and traditional cannabis. It's a bold strategy, but it requires a lot of consumer education. If they can capture even a fraction of the sober-curious market this month, it could be the catalyst they need. The recent stock movement has been a perfect example of buy the rumor, sell the news. The pop we saw in December on the reclassification news has largely been erased as investors realize that the actual implementation of Schedule 3 could take months, if not longer. This is the classic gap between expectation and reality. The market expected an immediate shift in the business environment. The reality is a slow, bureaucratic grind. This is why we are seeing the price hover around the $9 mark today. It's a wait-and-see zone. If you are browsing investing sites or looking for the best online investment opportunities, you will see Tilray mentioned alongside names like Apple stock or other blue-chip giants because of its high retail interest. But make no mistake, Tilray is a high beta play. It moves on headlines as much as it moves on fundamentals. Using the Robinhood trading platform for fractional shares makes it easy for retail investors to jump in, but that also contributes to the meme stock style volatility that can be dangerous if you don't have a clear exit strategy. Let's look at what this company actually does for a moment to ground the analysis. Tilray Brands is a global giant with operations spanning Canada, the US, Europe, and Australia. They are not just growing plants, they are a lifestyle and consumer packaged goods company. They have 40 brands, ranging from medical cannabis in Germany to craft beer in the United States. Their business model is built on the idea that as global regulations loosen, they will have the infrastructure already in place to dominate. In the past, they were the first to IPO on a major U.S. exchange, and they have always been aggressive in their M&A strategy. But older reports show that this aggression has led to significant share dilution over the years, which is a major point of contention for long-term holders. The future outlook for Tilray depends on three specific catalysts. First, the actual finalization of Schedule 3 reclassification. If this happens by mid-2026, the tax relief alone could be a game changer for their U.S. hemp and medical divisions. Second, their beverage segment. If craft beer and THC-infused drinks can start making up more than 50% of their revenue, the market may revalue them as a beverage company, which typically carries higher multiples than cannabis cultivators. Third, international growth. Germany has been a bright spot for them, and if more European European countries follow suit with medical or adult use frameworks, Tilray's established infrastructure in Portugal and Germany gives them a massive head start. However, the risks are just as prominent. There is always the possibility of further domestic competition in the U.S. from multi-state operators who are currently more pure play than Tilray. There is also the risk that the beer market continues to see overall volume declines, making Tilray's bet on craft beer acquisitions less lucrative than originally hoped. If you are using the SoFi investing tools to track your portfolio, you need to be aware that the downside risk here is a return to those 52-week lows near $3.50 if the growth story fails to materialize in the next few quarters. As we look toward the final section of today's analysis, it's important to remember the central theme of today's price action. We are seeing a stock that is currently priced for potential, but being judged by performance. The expectations of a federal windfall are being weighed against the reality of a company that is still burning through cash to build a future-proof ecosystem. Whether you are using the Fidelity mobile app for quick trades or the Interactive Brokers trading platform for deep technical analysis,